Hello everyone. A very good evening to all of you in Luxembourg, and good morning to Silicon Valley, of course, and a big thank you to all of us joining us today. I have the great pleasure of welcoming you all, and especially our expert speakers, Bill and Oscar, and my partner in crime, Breeze, today, to the first webcast of this new UL EY series on startups. Today is this first of the many webinars we would like to launch. We will, of course, focus on how to raise funds, and specifically in these critical times, what 10 things you should think about from the investor perspective and what they want to see in a startup right now. And most importantly, it is how to position yourself to get better attention and traction from the VC industry. The University of Luxembourg is really looking forward to this partnership with EY on this topic. And our goal with this series is, of course, going to bring you global experts and their recommendations on how we can bring some dynamism to our ecosystem and take it to the next level. So without further ado, I want to, of course, introduce you to my partner in crime, Breeze, who is going to walk us through the next sessions. Breeze is a consulting partner at EY Luxembourg and specifically focuses on advisory and digital innovation solutions. He is, of course, also the leader of the EY Luxembourg's digital transformation. He focuses on bringing innovation to multiple different sectors, from automotive space to also the banking and finance sector. Breeze, the floor is all yours.
Hey, thanks, Pranjul, and welcome everyone to this very first series of webcasts that together with Pranjul and the university we are glad to offer to you. And I will start by basically making a very short introduction to our first speaker this evening, which is Bill Reichert. To a certain extent, I was wondering or hesitating to make an introduction to Bill, because lots of you have been coming to Luxembourg EY events that Hélène in particular in our team has organized in the last several years, which is the Startup World Cup, and Bill every year has been giving a very inspiring and dynamic and also relevant speech to the startup and investor community in Luxembourg. So tonight I'm totally glad to have you on board, Bill, together with Pranjul. I just can say as a very short introduction that you serve as the partner for Pegasus Tech Venture, which is managing investment in the US. And you have helped, obviously, manage the growth of a number of companies, startups, scale-ups in the area, which AI, robotics, quantum computing, space, other sectors are involved. So we're looking forward to have your vision today on the things that investors are looking for at the moment when investing, and obviously in light of the consequences of the crisis, if any. So please let me welcome Bill. And Bill, the floor is yours.
Thank you very much, Breeze. I really appreciate it. And Pranjul as well. And thanks to EY and to the University of Luxembourg. I am delighted and honored to have the opportunity to be with you here this evening, although only virtually. I tell you, I way prefer actually being in Luxembourg and enjoying, being with you face to face, as well as the beauty and charms of the city of Luxembourg, in addition to the people. With that, let me jump into my presentation, my discussion of the top 10 requirements for raising venture capital in the current environment. So again, thank you, Breeze, for the introduction. Actually, sort of one of the key aspects of my background that is most relevant to this presentation is the first part of my career I spent as an entrepreneur. So I was an entrepreneur. I started my first company as a graduate student at Stanford and wound up starting or restarting 4 different software companies before I crossed over and became a venture capitalist. And what I discovered in that transition is that the common wisdom as to what the way venture capital works is not well disseminated in the entrepreneur community. When I was an entrepreneur, I thought that venture capitalists were these sort of brilliant analytical minds who could absorb all of this data and information and evidence and these slide decks and all this talk, and they had an algorithm in their head that they could process and calculate an internal rate of return and come up with these brilliant decisions. But what I learned when I crossed over and I became a VC, that it's very different from that. Early stage venture capital there's not enough data to do a lot of analytics. And so actually the big message I want to convey today was this epiphany that I had when I became a VC. And that epiphany is that VCs do not invest with their brains. VCs invest with their hearts. VCs fall in love with companies, and then they use their brains to rationalize their investment. So, God, I hope Oscar doesn't get upset when he hears this. But because I'm sure Oscar, when he's investing in funds, he wants those VCs to be these intense analytic engines. But the reality is it's not good enough to have a logical argument. You got to get investors to fall in love with you. And so that's sort of the core thesis of my discussion today. And what I'm going to share with you are the top 10 secrets to winning the hearts and minds of investors. So secret number one is you got to stand out. It's not good enough to have a nice slide deck with good prose and good pictures and logical arguments and some evidence and some good numbers. You got to figure out a way to stand out from the rest of the crowd. And so one of the challenges a lot of entrepreneurs have is that almost all of us were raised to believe that we're supposed to be modest, we're supposed to be humble, and it's not a good thing to brag. A lot of European entrepreneurs come over to Silicon Valley and they say, Bill, you Americans, you love to brag. We get that, but we Europeans, we're modest folk. But I'll tell you, look, here's the deal. The deal is that high confidence is way more exciting than false modesty. You have got to stand out. You've got to figure out how to get investors to say, wow, that is amazing. Tell me more, tell me more. So figure out how to stand out. The key to standing out, the key to getting investors to say, wow, that's amazing, is first, you've got to be clear what you're doing. It's astonishing to me how many entrepreneurs can talk for minutes about their company, and we still don't even know what really they do. So make sure that in one sentence, you can communicate clearly what it is you're doing. And then you can go tell stories and stuff like that. But we got to know absolutely what you do. Second, you've got to be compelling. Stop talking about your product and talk about the benefits that your customers get from your product. What is your compelling value proposition? What are the compelling benefits that are going to make customers fall in love with your product? And then thirdly, you've got to be credible. Too many entrepreneurs make these bold, brave assumptions or assertions that they're going to change the universe, but we don't believe it. We don't believe that. We need evidence that other people are backing you. You've got some incredible advisors, some incredible angel investors, or some incredible initial customers. So be clear, be compelling, and be credible. That will get us to say, wow, and that will enable you to stand out from the crowd. Lesson number two, down to fundamentals. Lesson number two, you got to get your fundamentals right. Okay, so the reality is when you're starting up a startup, we're investing money into an entity that we expect you to run properly. That means that you've got to do all these things that show us that you've got good governance hygiene in your company, that you've set up the company the right way, you're running it the right way in terms of all of the basics, compliance and legal structures and allocation of equity, your intellectual property protection, and how you're dealing with contractors and advisors. We want to see that that's all clean. You've got it under control. If we come across a company that's just been a mess in terms of the underlying governance infrastructure, we don't want to clean it up. We're just going to walk away. So make sure you have good advice, you have good lawyers that are taking care of this, and that you are squeaky clean in this regard. Third thing is you got to get your numbers right. So, legal compliance and contractor documents, things like that, you can have a lawyer take care of that. The numbers, though, that's your responsibility. You better know your numbers. So what are the numbers we really, really want you to nail? First of all, you got to get the market size right. Almost every entrepreneur gets the market size wrong. They Google the sector that they're in and they put a slide up that says, because it turns out e-commerce is a $2.7 trillion global industry, right? So we see this slide on this entrepreneur's deck that says we're going after a $2.7 trillion market, and it's baloney. That's not true. We want to know that you really, really, really understand who your target customers, exactly where they are, how you're going to get to them, how you're going to convert them, how you're going to upsell them. Show us that you really understand the segment that you're going after. Make sure you have realistic projections. We don't want them to be too low, but if they're delusionally high, then we're not going to trust you. You got to understand your sales cycles, your conversion rates, your unit economics, and you have to have valuation expectations that are reasonable for the current market. We can talk about that later in the Q&A if you want. One of the things I love to see in an early stage company is that they are disciplined day one. They've built a dashboard with their key performance indicators across each aspect of the company, and they're, from the beginning, managing their company as if it is a full-blown mature company. We want to see that you have that dashboard. Don't over-engineer it, but show us that you have key performance indicators, you're monitoring them, and you're managing your company accordingly. So, this is the advertising portion of the program. He inserts an ad in the middle. The ad is, I did a video course for the Kauffman Foundation here in the United States. The Kauffman Foundation is the biggest foundation supporting entrepreneurship. And so I did a video course called The Art of Startup Finance. If you're a little uncomfortable with finance, which is hard to believe for entrepreneurs in Luxembourg, but maybe if you're a little uncomfortable with finance, this course, it's only about an hour and a half, 10 modules, an hour and a half. If you go through this and you understand, everything I say, then you have a good enough understanding of startup finance. Lesson number 4. Lesson number 4 is we want you to build an unbalanced team. I know that sounds a little funny. Most people say build a balanced team. But so what do I mean by an unbalanced team? What I mean, I can explain in terms of a parable. It's the parable of the optimist, the pessimist, and the engineer. You've probably heard some of this before, right? So the optimist looks at a glass, sorry, my visual aid isn't quite right, but looks at a glass and says, this glass is half full. And the pessimist looks at the same glass and says, no, that glass is half empty. And the engineer looks at the same glass and says, this glass was engineered to be twice as big as it needs to be. And so the point of the story, raucous laughter in the background, right? Okay. And the point of the story is it's the same set of facts, but 3 different perspectives. And so what I mean by building an unbalanced team is it's not good enough to have sort of all the different skill sets. That's right. You got to have the engineer and the finance person and the salesperson and the operations person. You got to have skill sets, but you also need different perspectives. You need diversity of perspective in the organization so that you can see the world from all these different angles. Optimistically, of course, but pessimistically, you got to have someone who's paying attention to how to manage if things go wrong. And this third perspective I call the engineer. It's actually probably not an engineer, but it's the realist, the person who sees the world for the way the world really is. That is super rare inside a startup company, to have that sort of realistic perspective. The point is you want all these different perspectives. If you have these different perspectives, what's going to happen is you're going to start arguing. And that's where the unbalance comes in. But that's okay. Argument is good if you create a culture where you listen to everyone, you process all these ideas, and you come to a shared commitment to move forward. So having these different perspectives is hard to manage. It creates a little bit of tension inside the organization, but that can get you to the best outcomes. Lesson number 5. This sounds a little bit weird, but I'm telling you, it's important to learn how to steal. And what I mean by that is we want you to be an innovator, not an inventor. What's the difference between an innovator and an inventor? An inventor spends all of his or her time trying to come up with something brand new the world has never seen before. An innovator is a person who looks around the world and sees all of these amazing things and puts them together in a new way. And so we want you to be more like Steve Jobs than like a scientist inventor. What did Apple invent? You think about Apple and it's kind of amazing. One of the most valuable companies in the world, one of the most respected brand names in the world. What did Apple invent? Apple did not invent the microcomputer. Apple did not invent the mouse. Apple did not invent the WYSIWYG screen. Apple did not invent the music player. Apple did not invent the tablet. Apple did not invent the smartphone. Apple did not invent the smartwatch. Apple did not invent any of those things. What Apple did is they took technologies and made those ideas even better. So that's what we like in entrepreneurs, that entrepreneurs are happy to look around the world and grab the best rather than the entrepreneur who thinks, no, I've got to invent it all myself. So then lesson number six, we don't put enough emphasis on this in entrepreneurship training. We talk about customer discovery and we talk about product market fit, but what we really want to see is that you can sell, that you can go out there and you can talk to customers and you can convert them into paying customers. One of the most important things you need to achieve is customer traction. In order to raise capital, investors want to see you've been out there in the trenches, talking to the customers, working the customers, and we want to see traction with your prospective customers. Lesson number 7 is we want you to surprise us positively, but not negatively. You know, so many entrepreneurs that get coached, be careful you don't overpromise and underdeliver. You know, that's a bad thing if you don't, live up to your promises. And so generally entrepreneurs get coached, underpromise and overdeliver. And what I'm telling you is that's not good enough. Actually, you have to overpromise and overdeliver. If you want to stand out, you've got to outperform, out-execute everyone else around you. Lesson number 8, this again sounds a little bit weird, but believe it or not, we like entrepreneurs who are intolerant. Intolerant of slips, intolerant of mistakes, intolerant of things that aren't working out right. We want you to show an intense sense of urgency. So again, it sounds a little bit odd, but VCs do not invest in nice. We invest in urgent. So, I don't want you to not be nice. I don't want you to be, a negative word, but don't believe that it's important to be nice to the VCs. Go ahead and push them. Go ahead and show them that you have a sense of urgency, that you are intolerant of slips. Lesson number 9 is the best way to raise capital is to find some initial investors who are supporting you, who are interested in you, and then turn them into evangelists. So you can't do it alone. And the best way to connect with other investors is to have investors reach out to other investors rather than it being you alone. So as soon as you can get some initial traction with some investors, turn those investors into evangelists. It will be a test of their commitment to you, first of all, but I tell you, if they are committed to you and they start becoming evangelists, they will become even more committed to you. That is an investment of their own personal brand, of their reputation in you, and they're going to want to make dang sure that you succeed. And so lesson number 10 is, believe it or not, VCs do not want to hear you tell them that, we're going to make you a bunch of money. Because when we see an entrepreneur who seems to be motivated to make a bunch of money, we know it's highly unlikely that that entrepreneur is going to succeed. As soon as the going gets tough, they're going to say, wow, this is hard. There's probably a better way to make money. What we want to see is the entrepreneur who is focused on creating value, on making a dent in the universe, in making the world a better place for their target customers. Because if you're committed to creating value, when the going gets tough, then you're going to figure out a way to get past it, to get around it, to get over it, to go under it. But that's the kind of persistent, committed entrepreneur we want to see, the one that really wants to create value. The money will come later. The only way to create a sustainable, excellent organization is if that organization is committed to creating value. So those are the top 10 secrets to winning the hearts and minds of investors. You got to stand out. You got to get your fundamentals right. You got to know the numbers. You got to build a team with diverse perspectives. We want you to be an innovator, not an inventor, and we want you to show us you can sell, overpromise and overdeliver. We want to see high execution capability, be intolerant of mistakes and slips, show us a sense of urgency, create evangelists from the investors to fill out your funding, and then focus on creating value, not just on making money. So with that, I want to ask all of you entrepreneurs out there to do. So this is your startup action plan. So take these top 10 lessons back to your team, go through them. Some of you probably, you're better at some than others. Figure out where you're strong, where you're weak. How can you improve on your weaknesses? Put together an action plan that says, hey, we got to get better at sales. We got to get our numbers down. We got to clean up our infrastructure, whatever it is, or your weaknesses. And then how can you leverage your strengths? We got some angel investors. Can we put them to work for us to go out and evangelize for us? So I'm hoping you can walk away from this session with an action plan to go improve the way that you are scaling your business. And that, I hope, is going to be useful to all of you. So with that, the last advertising portion of the program is I'm co-authoring a book called The Art of the Pitch. I think you can pre-order it now on Amazon. Hopefully, we'll get it out by the end of the summer. And with that, let me turn it back to Brice, and let's see if we have any time for Q&A.
Yeah, thank you, Bill, again for those 10 principles. And I'm sure everyone is, and I see some comments on the side of the screen. I'm sure everyone is really taking this as a set of principles upon which everyone will do an action plan and cover gaps. And that out of this conversation, I'm sure there will be some enhancement in all the venture business plan and business model that are attending. So
Great.
Thank you again for that. And maybe I will start with one question, which is down to the point that you said that you need to turn investor into evangelists. But how do you turn investors not only into evangelists, but also into business advisors and partners?
Yeah, no, great question. I mean, once you get some investors, who are supporting of you, those are going to be some of your best weapons for scaling up your company, not just because of the money they bring, but because of the network and relations they bring. And so what you want to do is ideally early on find some really good angel investors who are willing to share their own experiences and provide you with good advice. It's a balancing act. You want an angel investor who won't tell you what to do, but will, share experiences and talk about pros and cons, provide advice, but let you and your team work out solutions. But then tapping into those investors for their network for business relationships, that can be incredibly invaluable. Or they can at least help you with the process of scaling up your sales and doing outreach. So yeah, angel investors or small funds, that you can bring in early days can be incredibly valuable, not just for raising money, but for all aspects of scaling your business.
Bill, I have one more question for you that I read from the participants. So someone is asking whether investors prefer straight ahead an innovative business model on really that is, for example, using a very disruptive technology, or do investors, and especially maybe in light of the current crisis, are investors sometimes just back to the basics of investing in some more traditional type of business? So how is the COVID situation changed the perception or the likelihood of investors to go more towards innovation or towards things which would be linked theoretically to more basic or traditional business?
Yeah, exactly. So yeah, I think there are two steps that we're going through now. There's the what are we looking for in the midst of this crisis, and then how is this going to evolve over time? So understand that venture capital investors are investing for the long term. So right now, what we're looking for presumes that the COVID crisis is going to go away. But we assume that this COVID crisis is also going to change the way we do things. And so it's pushing almost everything in the direction that we were going before anyway, which is digitization. And so what we're seeing is we're going to see increased digitization of the way we do business sort of across every aspect of our lives, of our business, of our entertainment, of our leisure time is going to be pushed increasingly toward digital. And less important is going to be the brick and mortar side of the world. And so, I mean, from an investor point of view, I got to tell you, commercial real estate is not exactly an exciting space to be in right now. In terms of things like hospitality and transportation, we know that will come back. It's not that we're looking for it now, but we know it'll come back. And then, just to finish up, the fundamentals are all still the same. Fundamentally, we're looking for companies that have a compelling value proposition. That's, so when you say back to basics, in my world, that's the basic. The basic is this a compelling value proposition for the target market going forward?
Two more questions, Bill, that I see from the people attending. One is on, you spoke about the teams, which is totally critical in your decision ultimately. How do you evaluate the resilience of the teams that you invest in?
Yeah, so, I get this question and I almost hate to answer it, because part of the measure of resilience that we can actually directly see is how do the teams deal with us? So, very frequently dealing with a venture capital firm is a very trying task. And so the way, starting with the first pitch, the way the team reacts to us is, sort of the only direct evidence that we have of the characteristics of this team. And so I hate to suggest that VCs try to manipulate entrepreneurs. We don't. But in the process of doing our diligence, we're going to push hard on you. We're going to push hard. And, every business model, every business plan, every pitch deck has, some weak spots or some holes. We're going to push hard. And it's not with the intent of making you defensive, but the reality is, depending on how you react, we get data on what sort of people you are. So, an entrepreneur that reacts defensively and angrily and insulted and frustrated or whatever, that's not a measure of resilience. That is not a measure of a open mindset or a growth mindset or an innovation mindset. We want to see entrepreneurs who are highly confident and are also open to listening to hear maybe there's another way of looking at this. Maybe there's a better way to attack this. So the irony, the reality of all of the work we're doing in due diligence, you think we're collecting data on financial projections and unit economics and competitive analysis. Yes, we're collecting data on that stuff, but we're also collecting data on you to see how you perform, how you react. So you say you're going to get us that competitive landscape tomorrow afternoon. Let's see. Are they going to get it to us tomorrow afternoon or not? And depending on how you perform on that simple little task, that's a data point for us on what sort of team you are. So be aware of the fact that every interaction you have with the VC is also an opportunity for you to display your strength, your confidence, your resilience as a team and as individuals.
So Bill, very last question, and I will say it's a question from Omar, because as you will see, I decline responsibility on this one, which is...
Wow, what a setup.
There's a small setup here. But what advice would you give to your younger self in obviously following those principles, or where you would have eventually done maybe a bit better or take a step back in your long-standing career? So what advice would you give to your younger self? I think it's a question from Omar.
Yeah, that's fair. The two big things are, one, this epiphany that I had that I didn't appreciate when I was an entrepreneur. Nobody was coaching me on the fact that VCs don't invest with their brains, they invest with their hearts. And, I thought it was all about gathering evidence and data and creating this massive 56-slide deck that would just sort of conclusively and definitively nail the case for our business. And, fortunately, that did in fact work. And maybe it was because of my co-founder and not because of me. But, appreciating that it's at least as much relationship as it is data in terms of dealing with investors and, of course, then dealing with customers and dealing with potential employees and all of that. And then the other thing that I would have told my younger self up until the point that it happened to me accidentally, I accidentally was forced to become the VP sales in one of my companies. And I'll tell you, it was the best thing that ever happened to me. And so if I were talking to myself before that event, which actually happened when I was 32, if I were talking to myself before that event, I would say, Bill, go out and do sales. Don't study sales. Don't learn about sales. Do sales. Go out and sell something. That's, I think, just critically important for entrepreneurs to appreciate.
Sales. All right, Bill, thank you so much for your inspiring, and I must say, not just inspiring, but very concrete speech and examples of what it takes to really appeal to the art of entrepreneur and what it takes for really making the difference with business venture, because I think all the principles and examples that you have shared, they are really concrete things that people should ask themselves whether today they are on the right track or not, and obviously use this opportunity today to take a bit of corrective actions, if any. And de facto, I thank you again for your intervention. We look forward to have you in Luxembourg as soon as possible, because we love to have you here. And we hope that's not going to be too far away from now. So thank you so much. And as a transition as well, I'd like to thank the 200 people that are connected to this webcast tonight, not to put some pressure on Oscar, our next speaker, because obviously if you speak in front of 10 people or 200 people, it's a bit of a difference. But the beauty of the technology is allowing us, obviously, to do this in a different way. So let me welcome, together with Pranjul, Oscar Flores. He's the head of the Venture Capital Digital Economy at the European Investment Fund here in Luxembourg. And as you may know, European Investment Fund provide risk finance to small, medium-sized companies across Europe. And with your team, Oscar, you are particularly focusing on the ICT sector. And as Bill has explained, definitely at the end of the day now, digitization is almost in every business model of the startup economy. So I think it's totally great to have you here tonight so that you give us the perspective of a major stakeholder in the European economy to obviously make those business ventures grow. So Oscar, floor is yours, and please share with us your perspective and insights.
Thank you very much, Brice and Pranjul, for the invitation. It's a pleasure to share EIF's views on the European venture capital ecosystem. Today, we are in the pre-COVID world. We are neighbors to EY. Now we are in the distance. But let me, after Bill's brilliant explanation and insights on how venture capitalists make decisions or make investment decisions, I would like to give you a top-down view on how the European venture capital ecosystem has evolved over the last years. It has been really a very interesting improvement and positive evolution. And you as entrepreneurs should be fully aware of that evolution and the current state of European venture capital, because it has an impact also on the messages that you want to push through to your potential investors. And what I will suggest is a few tips based on this current status. And at the end, finally, I promise you a list of 10 tips for entrepreneurs raising capital in the current COVID environment, which is a mix of my experience as now an investor in venture capital funds. Also, I did direct investments in the past in e-commerce and software as a service companies. And I was an entrepreneur myself. That was long time ago, I must say. First, the advertisement section. I'll try to keep it short, but I think it's interesting for you to understand the dimension of EIF. So we are the largest investor in European venture capital funds. We are a public institution, part of the European Investment Bank Group. We have been active already for 20 years when back in the days, the venture capital ecosystem in Europe was almost non-existent. So I think we had a key role in contributing to the evolution and creation of that venture capital market with some innovative products in the area of, for instance, business angel, co-investment products, social impact funds, technology transfer funds, etc. We have invested in more than 730 venture capital funds, which makes us investors indirectly into more than 8,000 European and non-European as well startups. And we say that we have 99% visibility on the European venture market because we invest in around probably 60, 70 venture capital funds per year, but we look at probably 300, 400 proposals. So that gives us a very good overview of what's going on. As an institution, we cover and indirectly the financing rounds of companies from pre-seed stage to late stage or development stage. You can see here in this chart, basically we have agreements with business angels to provide them with extra capital to deploy tech transfer funds. So that would cover the pre-seed stage. business angel, as Bill said, are very important to provide not only capital, but those initial experience and sometimes operational tips to make your company a success. We continue with seed phase, startup phase, covering different segments, as I mentioned before, social impact, climate, life science funds, ICT, etc., etc. And we go up to growth stages. And once the company is bankable, you might access loans from your commercial banks, which are warranted by European investment funds. I would like to structure the presentation this afternoon around conventional wisdom and European venture capital. I think European venture capital has suffered a long time from a certain conventional wisdom, which was not especially favorable to European venture capital. And I recognize we're still behind the US, of course, that's a fact, and we will see some numbers. But still, I think it's good to recognize that European venture capital has evolved very positively in recent years, and this has some implications for you. The 3 points that I would like to sort of prove wrong are first that typically we hear that there are not good enough investment opportunities in Europe, so why should we focus on European startups? Second, there is not enough capital to support and to finance those good startups that might appear in the European ecosystem. And the third argument is that, well, in the end, 1 and 2 might be true, but still performance is lagging behind the US. We'll try to provide some data, which, sometimes it's conclusive, sometimes not so much, but at least it would help the conversation. So first thing, since a few years, Europe has proven its ability to generate global category leaders. I think that's an important and fundamental change to previous perception of the European market, where, we were, because we are in the end still, 27, after Brexit, 27 countries in the European Union. We are 27 markets. And we were good at creating local champions, but not so good at creating global category leaders. I think this with companies such as Spotify, Farfetch, in gaming as well, Robio, Supercell, etc., has proven wrong. And as you will see as well, all the companies that you look here have been backed by European Investment Fund, again, indirectly through the venture capital funds that we support, but they are way more unicorns and global category leaders in the European tech space. Some numbers here, if you look at the evolution from 2010, so just 10 years ago, but even 5 years ago, the number of unicorns, so companies, European companies with valuation over $1 billion. And it's true, we still use the US currency for comparison and for qualifying a unicorn. But since 5 years ago, the amount of unicorns in Europe has more than doubled. And this has an implication for you as an entrepreneur, because now European venture capitalists expect to invest in global category leaders, or companies that could potentially become global category leaders, because this has certain implications in terms of exit valuation and return expectations for the fund. So in that sense, competition has increased, and you need to think globally. The creation of value is not only on paper, so unicorns are good, but as we say, dragons are better, and we define dragons as companies that can return a fund. So with a 100 million euro VC fund invest in a company, they would expect to invest at least in 1 or 2 fund returners, companies that can generate 100 million for the fund. This we define as dragons. And the exit activity in Europe is also on a healthy level. There was this spike in 2018 where there were a number of elements, mainly the top 10 IPOs of European companies in 2018 were higher in volume than the top 10 IPOs of US tech companies. And that was probably a one-hit wonder or one-time event, but it shows again that the creation of value beyond paper value in unicorns is real, and European global category leaders are also generating profits for the investors, for VCs and for the investors in VC funds. There is also a one argument that says that, there's not enough capital in Europe. I try, I don't raise capital, I should move to another geography. Well, it's not so true lately. And in 2019, we hit the level of $34 billion, in US currency. but $34 billion invested in European technology companies. To be noted that a big proportion of this capital came from non-European investors. So there is increasingly more and more appetite from non-European investors to invest in European tech companies. And maybe that's a question for Bill later. But as you can see, there is enough capital, and we will see we are still lagging behind the US in terms of VC investments as a percentage of GDP, but the amount is growing, and there is capital for good companies, or I would say for VC type of companies, because not every company is suitable to be financed by venture capital. The increased amount of available capital comes also with increased competition for the money and better teams. We are now seeing in Europe more companies created by serial entrepreneurs and more companies created by people who have worked previously in successful startups. So for instance, Rocket Internet is a great generator of successful entrepreneurs. And we are seeing more and more of that. And you need to be aware of that when you are also pitching to VCs. So there is also a steady creation of new venture capital funds, around 11 billion euros per year. And also an important data point for you as an entrepreneur is that the average fund size has also increased. That means that when a venture capital fund looks at you and your company, they will think, okay, is this going to be the next fund returner? And fund returner now means on average 145 million euros. A few years ago, it meant 100 million euros roughly. So you need to be aware of that also when you present or when you think about your exit expectations, value creation, and expansion strategy. As I said, there's still room to grow in Europe, and we are lagging behind. This data is a bit outdated. I couldn't get the latest data, and Europe has improved definitely, but still lagging way behind Israel and the United States in terms of GDP. Venture capital investments as percentage of GDP. So our take, we have a very positive view on European venture capital. Our take is we will be reducing the gap, so there will be more and more money available for startups. So again, don't be so much concerned about lack of money. You should be more concerned about having a clear USP and also doing your homework and knowing better the target and the investment strategy of the VCs you are pitching to, because that's also a characteristic of the evolution due to the steady creation of new VC funds. What we see now in Europe is that these, let's say, original funds, which were more generalist in a bit of everything, even back in, I remember, early 2000s, VC funds in Europe would have balanced strategies, life science and ICT in the same portfolio. That is unthinkable now. You have very specialized life science funds, very specialized ICT funds, even specialized in blockchain technology, artificial intelligence, marketplaces. You need to know the investment strategy of the fund you are pitching to. And this is usually not the case, I must say, from what I see in the market. The third argument is, okay, 1 and 2, all right, okay, you might be right, but still performance of European VCs lagging behind the US. We've seen a very interesting evolution in fund performance in our venture capital portfolio, especially since 2006 onwards. And we have dig deeper into the data and found what we think is one of the main drivers of that increase in performance. Okay, one is evolution of the startup ecosystem and what I mentioned about the creation of global category leaders, which has an direct implication on company valuation. But also a second very important factor is the more professional and disciplined approach to follow-on investments. So when you pitch to a VC and even hopefully you get money from a VC fund, you need to be very clear with the milestones that you want to show in the next financing round. Because especially with cash-consuming business models, you will be raising money again in 12, 18 months. If you don't show the right milestones, and especially in this COVID environment where VC managers are more and more cautious with follow-on reserves, you might find that the VCs that were supporting you will pull the plug and say, look, sorry, I have better options in my portfolio. You're out. We don't support you anymore. And of course, you need to find then external capital, and you need to explain to a VC that doesn't know you much that your existing investors are not supporting you, hey, that's a tough sell. So also when pitching to VCs, be mindful of your financing route and next milestones and next financing rounds as well. European unicorns, according to our data, are slightly more capital efficient than unicorns in other regions in the world. That might be due to historical reasons. And yeah, historically, there was less capital, and still arguably there is less capital available in Europe for startups. So maybe out of necessity, they just are more capital efficient. But I think that's a good characteristic in times of Corona crisis, because capital efficient is becoming a key decision factor for VC funds. Cash runway, protection, preservation of cash are words that come to the mind of any VC manager when looking at a company, a capital efficient business model. In that sense, we believe Europe has a certain advantage. What we can see here, without going much into the details, but you will see with a yellow pointer, the multiple of capital, that is company valuation divided by invested capital at the time the company became a unicorn. And then with the red pointer, you will see that same multiple at the time that the company was exited. So you see in European unicorns, both in life science and ICT companies, there is a positive evolution and let's say even increased efficiency once the company becomes a unicorn, which does not happen necessarily in other geographies. And the question that we always get from investors in VC funds, okay, yeah, but are returns good enough? And again, this is our data. There might be other data around. We take our own portfolio and also Pevara as data provider. And this is the top quartile cutoff internal rate of return for VC funds in Europe and the States. And we see a huge and significant gap up to probably 2009, even in 2010. But then gaps starting to reduce. So in that sense, we are very positive. And again, this is not meant to be sort of starting a war, between US and Europe in terms of who has the highest returns in venture capital. Of course, I mean, the US is still the reference in terms of venture capital. But this is just to say that, hey, in Europe, we get very good returns from our investments in technology startups. We see a positive evolution in that. So there is no reason not to invest in European venture capital and not to invest in European startups from a return perspective. But obviously, things have changed dramatically, I would say, in the last 4 months. Who could imagine? I was in a venture capital event in Berlin late August. There were already some managers not attending the event. It's called the Super Venture event in Berlin. Basically, all the European ecosystem gathers in a hotel in Berlin, and 2 days of continuous meetings and exchange of knowledge. So at that time, who could imagine that 2 weeks later we would be under lockdown? We could not travel. We would have difficulties in executing transactions, and basically the world would have changed so much. But this is the new reality. This is the new normal, and we should learn how should we position ourselves in that environment. So we conducted a survey among 200 venture capitalists in our portfolio, and this is the highlights that we can extract. First, I mean, clearly there has been a short-term, and this still is a short-term negative impact in certain verticals. So any company in the travel tech space, it's going to be tough times to raise capital. I've heard that space has been recovering lately a bit to some extent, but of course, your USP needs to be rethought now in this COVID environment. Mobility as well, so taxi hailing companies, etc. The main concerns from the fund managers, and that is of importance to you as an entrepreneur, ability to exit companies, so maybe not immediately, but in the medium long term, of course. Syndication opportunities, this is important for you because in this current context, VCs are more aware of their limitations in terms of follow-on reserves and ability maybe to raise a new fund in a few years and continue investing. And also the ability from other fund managers that typically were co-investors in rounds to syndicate for a specific round. So VCs are now basically counting just on their own money, and if there are co-investment opportunities, that's fine. But as a protection measure, you should count on your money. That puts some pressure on follow-on decisions as well, and of course on decisions on new investments. new investments as opposed to keeping and preserving capital to support existing portfolio companies that might be in difficulties and might not get external money. Deal execution was also a concern. How do we execute a deal now remotely? We cannot meet the entrepreneur, we cannot exchange, we cannot meet face-to-face, we cannot stress the entrepreneur, as Bill said, we cannot test him face-to-face and see his or her reaction. So that's a concern. Despite that, deals are being closed. I mean, we know we have a portfolio of probably 400 active managers, and we see deals being executed every day. So most affected areas, of course, sales and fundraising. The operational focus from every single manager is cash runway and extending and protecting that cash runway. It relates to a cash burn and ability to take or generate liquidity from every dimension. But despite all this, VCs remain confident, and we, EIF, remain confident on the European tech scene because we believe that the strong tailwinds for European tech remain and will prevail. As it has been said as well, the current crisis makes digital transition even a more decisive competitive element. The quality and quantity of deal flow is there. Even from previous crises like 2008, we saw an increase in entrepreneurs and quality entrepreneurs coming from successful startups. And there are, of course, opportunities to invest in good companies at good valuation. And we'll come back to that point on valuation because finally, and I think we are approaching the time limit, as promised, I'll give you 10 tips for startups raising capital. First thing, think beyond borders. Europe is no longer a land of national champions. That could work as well, of course, but that means for a VC, an exit of about 100 to 100 million euros probably. And if the venture capitalist has a 200 million euro fund, your company is not going to be a fund returner. So, there's not so much interest in investing in your company. Think globally, build or try to build a global category leader. Find your category and aim for leadership in the same line. Do your homework. Very important. What type of VC do you need? Specialized VC. What is the network of that VC? Does the VC firm has a growth platform, a platform of operational partners that can help you with sales, marketing, HR? I don't know. Some VC firms in Europe do have such a platform with very talented people that will help you. VCs, look for returns. Show them the money. Bill said, look, more than showing them the money, show them that you will build a great product. I totally agree with that. I couldn't agree more. But in the end, again, it's about returns and exit potential. Capital efficiency nowadays in the COVID era is music to VC's ears more than before. Capital efficiency, cash preservation. What are going to be your milestones as well in the next financing round? Know your runway, very linked to the previous point, or as we say in the startup world, and sorry about that, but cash is more important than your mom. And that is something that every entrepreneur, every CFO of a startup should have in his or her office. I mean, this is really the focus. Lack of cash will kill your company. Lack of cash will kill your company. You might even have sales, but if you don't collect the money, because we are in a COVID era and SMEs that you are targeting are in difficulties that don't pay, you are out of business. What is your USP in a post-COVID world? When I talk to managers now, they tell me, look, we continue more or less with our investment strategy. If we invested in disruptive technologies, we will continue investing in disruptive technologies. We will not move now to marketplace or wherever, but we want to know very clearly what is your USP in a post-COVID world, because there are some elements that will change for sure. Valuation is not everything. Sometimes entrepreneurs are very concerned about valuation and, hey, I want to show that, I achieved a 5 million pre-money valuation because, my friend got 4 money pre for his startup and I want to be obviously better than my neighbor. Well, valuation at face value is not everything. You need to think about dilution. This is the important metric for you, dilution, how much ownership you will have. And obviously, it's very linked to valuation, but valuation is only one part of the equation. Think about stock option plans, think about ratchets, think about liquidation preferences as well, or protection clauses or mechanisms that the VC might introduce in the shareholders agreement. And think also about equity story. Yeah, you might be super happy today because you got, 20 million pre-money valuation for your seed company. And then when you get to Series A, the market will only pay you 15 million pre. So yeah, you made it big in the seed round. Probably some of the investors did not get the numbers right, but then you will be in a very difficult position unless you show a great value creation to raise the next round. Number 9 is make the most of a no. So you will get a lot of no's. You will knock on 100 doors, 99 will tell you no, sorry, we are not interested, and 1 will tell you yes, let's talk about it, let's sit down and talk around a term sheet. So try to make the most of a no, don't get discouraged because again, you will get a lot of rejections. And the last element is basically something that I've seen as well in entrepreneurs. Fundraising takes a lot of effort from you. And you start fundraising and you have a nice revenue traction. At the end of the fundraising period, your revenue story is not as nice. And sometimes revenues just fall or even decline. You need to be prepared first not to lose focus on the revenues and survive throughout the fundraising period. Plan in advance, don't defocus too much from revenues. Because now in the current environment, closing a fundraising round might take longer than expected, and that might, again, either take you out of business, unlikely, but it could happen. But secondly, most important, put you in a very weak position vis-a-vis potential investors. That is my advice. I hope the view from EIF was somehow complementary to what Bill explained, and happy to reply any question you may have.
Thank you for that, definitely, Oscar. And I can start with the first question sent by some of the viewers. So one very first question it is, do you see what are the main benefits or difference for a startup to seek public versus private investment?
Yeah, I would say in Europe we have the advantage of having very interesting public funding programs that I think should come in addition to private money. So the ultimate test for a startup should be the ability to access private money, but then do not disregard the sort of very favorable conditions of some public money programs, which are sometimes in the form of non-dilutive capital and certainly available to some volumes that are very, very appealing. When I was doing direct investments, for instance, we try to leverage as much as possible on public financing as well.
Now the question for you, Oscar, is how do you see the rise in impact-oriented funds? How is it compared to classical money?
Mm-hmm. It is definitely a strong trend towards positive impact funds, and we have been pioneering impact investing from EIF. So we have a specific program to support social impact funds that would invest in social impact companies. That is, companies that ultimately have an objective to change a societal challenge. The difference, I would say, for instance, when we support a social impact fund, we want to see on top of the financial metrics, we want to see social impact metrics. And both dimensions, financial return and social impact metrics, play a role in determining the remuneration of the manager. So in that sense, for social impact companies, I think it is very important to have a very clear plan on what social impact metrics do they want to achieve and how they're going to monitor them. But definitely there is an increased interest and increased appetite and investment volumes in that space.
One more question while I ask maybe Bill or Pranjul to think about a question which they would want to raise. With the recession beyond COVID, do you think the VCs and their portfolio are equipped to survive this downturn that may prolong?
That is a very good question. We have still questions on the duration and depth of the crisis. What I would say is sort of different from 2008. I mean, the venture capital ecosystem has evolved so much. The amount of dry powder available is much higher. Also, the knowledge of how to operate in a crisis environment and how to take follow-on decisions and when to pull the plug is also more developed. So VCs will be more focused on supporting those companies that can really make it through the crisis. The question mark is the appetite from the investors in VC funds, from limited partners, in continuous supporting venture capital funds in the following years. We have seen recently, in the middle of in the peak of the COVID crisis, a certain reluctance from some type of limited partners to invest in venture capital funds, especially the sort of less institutional family offices, private individuals who might have some liquidity urgencies. But the institutional limited partners that support the European venture capital ecosystem are there for the long term, and they know that vintages, that is, funds that are raised in crisis period, might offer superior returns because they will invest in, let's say, favorable conditions in terms of valuation, and the companies might be exited then when the economy is recovering. So we think that now the European VC ecosystem is well equipped to survive through the crisis. We, as European Investment Fund, are also preparing, in collaboration with the European Commission, new instruments and hopefully increased volumes to support the European VC ecosystem. So there will be money to support and to maintain what has been achieved in the recent years.
Maybe Bill, asking you if you have any perspective on this capability of the VC fund, obviously, to go beyond the crisis, and if you have any question as well.
Yeah, in terms of the U.S. venture capital industry, the reality is that there are just huge pots of cash that are looking for return, and so there's plenty of cash around. So I'm not worried about that. Actually, some of my brethren think there's too much cash, but that's a different discussion. In terms of the future of the U.S. VC industry, I do think that you're going to see somewhat dramatic differentiation, as you might say, in returns to the funds going through this crisis. Aside from just the COVID part, the recession part, you're going to see something like what we saw post-global financial crisis, where funds that in 2019 were exhibiting these extraordinary return numbers on paper, all of a sudden it's going to be a little less extraordinary when they mark to market in 2021. But and so that'll affect some number of funds' ability to raise the next fund. There's plenty of depth and breadth in the U.S. venture market, and so there's no concern that somehow there's going to be a serious retrenchment of U.S. venture capital.
So the world is ours, I must say. Pranjul, go ahead. Yes.
It's mostly a question to Bill and Oscar. I think for all the audience here, all of them are interested in, of course, raising funds. And Oscar lives here, and Bill, you adopted Luxembourg. And I think it's a question for all the 300 to 400 startups that we have in Luxembourg. How can we make Luxembourg startups? How can we ensure a vibrant VC, industry in Luxembourg? I mean, EIF is, of course, in the backyard, but we continue to not have an active VC industry. And what can we do? And Bill, should we get you a house near Moselle? What can we do to bring you here? But the question really is how can we make sure, I mean, the economy, like the whole startup ecosystem, which has now started to, the engine, the wheels have started to turn, and the COVID might, slow them down. But how can we make sure that post-COVID we're going to accelerate this?
Yeah, I think it's easy, to be honest. And I'll show you, I'm only half tongue-in-cheek. The opportunity, I think, for Luxembourg and for Europe more broadly is, rather than seeing startup ecosystems as sort of competitive alternatives, look at the opportunity to bridge between the startup ecosystems. And so it's not a matter of whether Europe has better or worse returns or performance than America. Luxembourg should take advantage of the best of both worlds, which is to say, you get the nice thing about Luxembourg is it's pretty easy for you guys to attract from the region. I've seen you guys be extremely supportive of entrepreneurs. It's not just about money. It's beyond money. It's about helping entrepreneurs make it through each successive stage. And then the question is, and this is actually, I'll put this back to Oscar and you guys as a question as well as a perspective. Our experience perspective in the United States is that we hear European entrepreneurs say, it's really hard to scale in Europe because as much as we'd like to say, Europe is a single market, It really isn't. It is much easier to scale in the US than it is to scale in Europe. So the secret to the future success of Luxembourg is become the launch pad for global category leaders that then, sort of establish, validate, figure it out, and then go, probably to the US, in some cases, maybe China, that's another discussion, and then, make sure that you have a pathway to scale in the US. It doesn't make sense for every company, obviously. There are some companies where it makes sense for them to stay in Europe. But I do think that there is this opportunity, instead of thinking of us as two separate ecosystems, to bridge the ecosystems and give entrepreneurs the opportunity to take advantage of the best of both ecosystems. So, Oscar, does it concern you that we want to take your young and bring them, steal your young and bring them to Silicon Valley? Is that a no-no for me to say?
No. I mean, we see that, and we also see U.S. money flowing into European startups. That probably we are more interested as an European institution. But I would add to what Bill, you just said, that what we see in Europe is that it's not longer, and you described it very well, it's about bridging ecosystems, because now there is more mobility overall within Europe. If we look at Europe, mobility of talent and mobility of capital. So now what we see in Europe, unicorns can be born anywhere. We have a great case, UiPath, artificial intelligence company focusing on process automation, born in Romania. And who could think, some years ago that this could happen? And we hear unicorns being born and created in remote areas in Europe. So I think in that sense, what needs to be considered, particularly for Luxembourg, first take advantage of that increasing mobility. And I think Luxembourg has an opportunity to attract first talent. And I've been here for 7 years. I've seen a great evolution in the city and developments at the university, in the different institutions. So I think we are better positioned now than a few years ago to attract talent. We need to be prepared for that. Luxembourg is creating these international schools, free of charge English schools following international baccalaureate. I mean, that's a great initiative to attract international talent. Second, attracting money to Luxembourg. I think that's easy in a sense. I mean, that's been one of the assets of Luxembourg because of a stable regulation and very clear rules and investor protection. So we need to leverage on those elements and be aware as well as that creating a startup ecosystem, basically it's a virtuous circle where you need to start with talent and people creating this first wave of startups that we will get money from here and there, maybe starting with family offices. I'm sure there's plenty of money in family offices in the region, family offices, business angels, maybe one or the other foreign VC fund, turning these ideas into successful startups, growing them globally, to Bill's point, using Luxembourg as a launch pad, and then obviously exiting those companies and generating very beneficial spillover effects that will feed back into this virtuous circle. So generating returns for everybody. Some of them, most of them will be reinvested in the venture capital, in the startup ecosystem, and also having a very positive spillover effect on talent. So these people that have been employees of a successful startup, some of them will start their own companies later on. And if they've done that in Luxembourg, they will start in Luxembourg. So it's a matter of time, being constant, having a very focused policy sustained over time.
Well, I think on these words, I would like obviously to thank you guys, Oscar and Bill, for your contribution tonight and really enlightening all of us here on really what are the tips, the trends, things that everyone trying to start a venture or grow a venture needs to consider at the moment. So thank you really, Pranjul and I really want to thank you a lot for this evening. Lots of questions that I have seen. I couldn't ask every question, but we have had over 200 people tonight. So together with Pranjul, we look forward to welcome you in the next event. And maybe as a conclusion, please click on we are going to start a new hashtag. Bill is coming to Luxembourg. So please support this new campaign so that next time he can come, we can keep him a bit longer. So Thank you so
14
much.
days in quarantine, right?
14 days in quarantine. So Bill is coming to Luxembourg in quarantine. So we definitely, we thank you guys, Bill and Oscar, for your words tonight with Pranjul, and have a good evening, everyone. And we look forward to organize the next event. You will see, we'll hear about it soon, and we continue on that series together with Pranjul. Thank you all. Take care.
Thank you. Thank you very much.
Thank you.
Thank you.
Have a good evening, everyone.
Bye.